Hey guys, welcome to the State of the Market. What's next for multifamily webinar tonight? Thanks for joining us. Really appreciate you taking the time out. We had a little bit of a glitch on the original video, so I'm trying to patch it in here. But bottom line is we're excited to share some great information with you about what we're seeing in the market and why we think this is actually a really good opportunity to be invested in multifamily. Hoping we can add some value here this evening to your investment decision-making process so that you have the data to make an informed decision and really can be knowledgeable about what's ahead. I really like to look into the data, and so I started doing some research, which I normally do, and I thought, this might be a good opportunity to share it with you guys and hopefully give you a little more, some direction in terms of what you're trying to do for investment purposes. So there's a lot of data in here, so I apologize if it gets a little bit tedious. Sometimes data can be that way. I'll try to make it as interesting as possible and try to, keep it concise. But there are a lot of details, as you can imagine, to how all the economics of things go together. But they're, I've basically organized it where I've got some data up front that we'll talk about. And then we start to draw some conclusions and assumptions based on that data towards the end that give us a little bit of, I would call guidance for where we're headed, what we think is going to be happening in the market, and sort of, you might say, an REM Capital investment perspective based on what we're seeing in the market today. So, again, the question is, state of the market, what is next for multifamily? I think probably the easiest place to start is with the historical consumer price index, the historical CPI. Now, we all know that we've seen a dramatic increase in the consumer price index, i.e. inflation, over the last few months. And as you can see here from my graph that I pulled off of the Federal Reserve, I forget which one, I think this is the St. Louis Fed. You can see that our inflation rate, the CPI, has gone up pretty consistently, and it leveled out over the last few months. And we did see a drop to 7.7% on the last, I think it was last week or 2 weeks ago. We saw that consumer price index dropped to 7.7%. Now, it's still historically high, and it's still obviously at a point where there's a lot of concern, but it's at a better place than it was a few months ago. It's trending down. That's a good sign, but certainly it's still pretty high. The reason that I wanted to point out this graph to you is because you can see that we've had consistent inflation, at least going back to 2013. So inflation is not something new. It's just that the pace of inflation has increased dramatically in recent times. And not surprisingly, if you look at the time frame for when that inflation really picked up, it was roughly after the Fed decided to dump somewhere in the neighborhood of $9 to $14 trillion into the economy. And any of us who are basic economic students, we know that supply and demand is the basics of economics. So if you dump a bunch of cash into the market, you will have a lot more inflation. So that's kind of what we're seeing today. And of course, the Fed is trying to slow it down by increasing interest rates and causing everybody to crash and burn. I'm just kidding, not really, but sometimes it does feel like that with where things are at. So, secondly, I want to dig into the numbers behind this CPI, the CPI number, this big bucket that they use for the consumer price index. And there's a lot of different factors that go into it. As you can see on the screen there, we've got food, energy, electricity, apparel, medical care, shelter, education, food, what do we got? Gasoline, natural gas, commodities, new vehicles, services, and medical care services. So a lot of different components that go into this consumer price index. And I wanted to pull out two that I think are very relevant to our discussion. Number one, I pulled out food at home, meaning groceries. What does that look like? What does it look like over the last few months? And you can see by the graph there, it's the darker color that shoots way up on the right hand of the screen there. Food prices have spiked tremendously over the last few months. Now, as you can tell, if you go back, this goes back to 2002, so it's about 20 years of data. We've got ups and downs in food prices. And the latest big spike was in 2007 and 8, and it dropped way down. Then it came back in 2011, and then it kind of dwindled off. And then, of course, recently it's spiked quite high. So we do have a fairly, I don't know, I'd call it a fairly volatile situation with food. So it's not totally unusual to have spikes in food prices, but the recent increase is certainly a big one. So that's number one. Number two is shelter, meaning that's our home, that's our rent. What's the cost of that relative to the inflation rate? And as you can see on the purple line, it is fairly consistently increasing from about September of 2010 when it was close to zero. It went up until about 2016, kind of leveled off from 2016 to 2020, then took a little bit of a dip. And since about, call it late 2020, early 2021, it's just been on a tear. And we all know that to some degree, the rent increases that we've seen in the multifamily space contribute to that increase in the cost of shelter. Now, one thing I want to point out is that if you look at the inflation rate for rent, it is at an all-time high for the last 20 years, but it's not way out of whack like food. Although food is a little bit more volatile. If you look back at 2006, you'll see that the rate was pretty high back then. It was about 5%, and now we're running in the 6-7% range. So it is a little bit higher, but it's not completely out of line. And secondly, if you think about the fact that it has been in the 0 to 3% range quite a bit over the last 20 years, certainly the last 15 years, it almost seems like it makes sense that there should be some increases in that shelter cost. So anyway, I want to point that out because there are different components that make up this consumer price index, and they affect the inflation rate. And two of the biggest ones that are driving it is food at home and shelter or rent. Now, in our business, in our industry of multifamily, we want to see rental increases. That's certainly something that we feel is helpful to our business model. Now, we also want to see wage increases because people obviously have to afford that increased rent. But I think the key here that I want to point out is that this is a data point to the overarching situation in the multifamily market, which is a supply imbalance, meaning we have a shortage of supply in the market. We have an increasing demand for apartments, in large part because mortgages have become less affordable over the last few months especially. And we have a tremendous supply imbalance because people have not been building as many units as are needed to replace the number of new folks coming into the market, or I should say to accommodate the number of new folks coming into the market. So two big numbers that affect the CPI quite a bit: food at home and shelter. A lot of the other ones are a little bit more less influential and not as extreme as these two, and so I wanted to point that out. All right, so that's digging into numbers. Secondly, I wanted to look at something called the FAO World Food Price Index. Now, this graph, as you can see, is pretty dramatic. 2015 to 2020-ish. It kind of ranged from 90 to 100 on the scale here, and then all of a sudden it took off like a rocket and just about doubled in the course of about a year. Which is obviously a problem because that's indicative of a lot of inflation happening. However, in the last few months, we've seen that food price index drop off tremendously. Now, what does that mean, or what could that mean? The reason that I put this graph up is because I think this is a leading indicator of what will happen to food prices over the next few months. So a lot of times with food, it takes a while to work its way through the food chain. So you've got food prices that then translate into actual retail, that translates into restaurant and food at home costs. So we're seeing a dip in that food price index, which is a good thing. It could mean, and I think it probably does mean, that we're going to see a decrease in the cost of food, which right now is a major contributor to the consumer price index. So if we see that consumer price index go down, that's a good thing. Everybody wants to see that, including the Fed, which will then allow the Fed to ease off on those rate increases, which to some degree is what's concerning most of us, because we're looking at higher interest rate costs, companies laying off a lot of workers, and how that's going to affect the economy, which of course affects multifamily, because we need people that have jobs that can pay rent. Okay, so I want to move from the food price index, which is, a very narrow item related to the cost of food, and move over to what's called the producer price index, the PPI. This graph goes back to 2013, and it shows you the producer price index. And the producer price index is the input costs of materials in the economy. So basically, the costs of things that are then put into retail or consumer products, and then of course that translates into a consumer price index. So what does that look like for where we're at today? And of course, again, as you can see, in 2020, shortly or right about the time the Fed decided to really open up the floodgates with the cash infusion or whatever it was, the balance sheet infusion, the quantitative easing, we see that the producer price index took off. So the cost of producer of that, those inputs into the system took off. And then, as you can also see, over the last few months, it's dropped off a fair bit. And so again, that's a positive note. We're seeing that the effects of the interest rate hikes that the Fed is pushing through have definitely made a dent in that producer price index. But a producer price index, to some degree, is a leading indicator, because as those prices drop, then the month after or 2 months after, whatever it is, you're going to also see the consumer price index start to drop as well. So again, we're seeing the effects of the Fed's interest rate hike in the economy. This is what we want to see, and again, these are all pointing to the conclusion that what the Fed is doing is having an effect, the desired effect. The question is how much and how far to go. Excuse me. And that's really, to some degree, that's kind of what we're trying to answer too, is where are we at in this tightening cycle, and what does that mean for multifamily? All right. One other thing I want to point out, spot container rates. Now, this is the cost of a shipping container of goods being shipped on average. So, aside from, let's leave aside the rate and just look at the numbers on the left there. So you can see basically 2019, 2020, 21, we were, let's call it somewhere in the 2 to maybe 3 range, really the 2 range. It went all the way up to over 10, and then now it's back down to 6. So we saw this huge spike in the cost of shipping, almost a 5-fold increase in the cost, more than a 5-fold increase in the cost of shipping. And it has since dropped by roughly 50%. So again, this is a major component of the cost of goods. And we've seen this start to drop quite a bit, which again will translate into lower costs at the consumer level and at the producer level. So this is a good sign. We want to see that those spot rates are dropping. Now, they're still quite high relative to 2019, 20, and 21, but, and this is my opinion, I think those container rates were, I don't know if I would say artificially low, but I think they were not at a sustainable level back in 2019 and 2020 and even parts of 21. So I actually feel like it's going to level out somewhere in the 4 range and not go back down to the 2 area. But again, we'll see. So, but again, I guess the point of me bringing this up is because I think this is a positive sign in the cost of shipping that has also moderated over the last few months. Okay, So we go from the last few slides, which are talking about producer price index, consumer price index, cost of goods, what's happening in the last few months. We're seeing prices start to come in and drop based on the Fed. And then I want to switch over to talk a little bit about the debt market. So I think it's important to look at this because we need to understand where we're at with regard to borrowing in today's economy relative to 2008. Now, in 2008, as you guys all know, the financial system essentially crashed the economy. The financial instruments that were being used, the leverage that was being used, essentially caused a financial collapse of the economic system. And again, you can see that in the graph here, 2008, 2009, 2010, 11, you see a massive drop in commercial paper. Now, let me explain a little bit of what commercial paper is. Commercial paper is essentially very short-term borrowing by companies. So you can see prior to the drop in 2008, it was pretty consistent through, a few years there. And then all of a sudden in 2007, it just started to take off. Huge amounts of debt, borrowing, short-term borrowing. And then the crash happened and it just completely got wiped out. And if you look at where we're at today, we are still at a very historically low point in that short-term debt. Now, this is just one piece of the debt picture, so I'm not trying to say this is everything, but I do think it's important because if you look at a graph, we've gone from $1.2 trillion at the height prior to the crash in 2008 to about, call it 300 million in today's market. So a fraction of what used to be out there in commercial paper. So this is a good sign from a leverage standpoint. And this is a sign and a data point to why I don't think we're going to have a repeat of 2008, where there were, assets and valuations that were selling for literally pennies on the dollar. Now, that doesn't mean we're not going to have some discounts, and that doesn't mean we're not going to have some opportunities, because I do think we are. But I think this data is a data point, if you will, to why I think we are not in the same financial situation that we were in back then. Okay, so from that debt component, I also want to talk about the sort of the current GDP situation. And GDP, for those of you who may not be familiar, it is the gross domestic product. So this is the production in total of the economy. And typically we measure it, in this case, in terms of percentage growth or decline. So a positive GDP growth means the economy is expanding. A negative GDP growth means it's contracting. And, generally speaking, we want positive GDP growth. So in the third quarter of 2022, we had a pretty decent 2.5% GDP growth. And so that was good. But then what actually made up that, that picture? What were the biggest factors? So if you look here, I've broken out housing, change in inventory, government spending, business investment, consumption, and net export. Every single one of these categories, with the exception of net exports, is negative. That means that the housing market is shrinking. The inventory market is shrinking. Government spending is shockingly shrinking. Business investment is down. Consumption is down. So the only component of GDP that is essentially propping up the entire economic outlook, if you would, not outlook, but the economic production, is net exports. And the reason I bring this up is because the Fed, they're looking at a big picture. They're looking at the inflation rate. They're looking at trying to control what's going on with the value of the dollar. And there's a lot of different components here. But my argument with this slide, and again, this is the data point, my argument with this slide is that the actual economy, the core economy, if you will, housing, inventories, which of course is based on government, businesses, holding stock of product, government spending, business investment, consumption, they're all down. So we already are in a contracting economy, regardless of how it looks on the outside. And so again, this is one of the reasons that I believe that the Fed will not be able to continue to push interest rates too far, too fast, without doing some pretty serious damage to the economy. And at this point, it's being held up by net exports. So again, my point in bringing this out is that I think we are in a situation where the economy is not as strong as the Fed may think. And I think this will also help to allow them to bring the interest rates back down in a fairly quick fashion. All right. So in summary, there are these four sort of major issues that are facing the Fed right now. Supply chain issues, which is things like cost of shipping, ability to ship, getting product into the store, things like trucking and trains and ships and all that kind of stuff, getting product there. And then, of course, just having enough production at the actual facilities. So, the chip manufacturers not having enough chips to be put into cars. And so that, of course, affects the production of cars and all kinds of other things. So we've got supply chain issues. The Fed is also working on the reversal of quantitative easing. So that 9 to 14 trillion, whatever it was, how do they pull that back out of the economy? And for those of you who have read my CEO blogs, probably a month or two ago, maybe longer now, I don't know, I kind of argued that to some degree the drop of the stock market equated to essentially taking all of that money out of the economy. Now it's way past that number now. Back when I noted it, I basically said, hey guys, the stock market's dropped X percentage, which if you look at it from a dollar perspective was about $15 trillion. I think at this point it's gone well past that. So again, in economics, it's not necessarily a one for one. We put $1 out of this account, we get one back. You can take $1 out of this account and you might get one back in a completely different account. So again, I would argue that there's been a huge reversal of quantitative easing just by having the stock market fall so much in value. And then, of course, sanctions is another thing that's kind of a issue for them. And then the war that's going on in Ukraine and other areas around the globe that's affecting supply chain and costs and, oil and natural gas and things of that nature, especially in Europe. So a lot of different factors that are going into our current scenario. So let's take a look and kind of switch from some of the data points and the debt and what's going on in the economy to the Fed funds rate. This is the rate that basically drives interest rates, the SOFR rate, which a lot of our loans are based on. What does that look like? So the Fed funds rate, as you know, recently it has shot up quite a bit, which you can see on the right hand of the graph there. You can also compare that to back in 2016 when the Fed raised the rates up to about 2.5%, topped out in 2019, and then they dropped towards the beginning of 2020, stayed near zero until just recently. And the one thing I want to point out here is that we've seen an increase in the interest rates that is somewhat unprecedented in recent, not so recent history with the Fed. So they're taking a very aggressive approach to try to bring the inflation back down. But that being said, I also want to point out that if you had been an investor or a potential investor in 2019 and you had watched interest rates go up for 3 years, 2016, 17, 18, 19, you would have missed, want to call it 3 years of incredibly good returns for multifamily. And some folks would say, well, that's because the interest rates dropped. I would say that certainly helped because cap rates were compressed and we got a lot of return just because of those cap rates being compressed. But we also saw tremendous rent growth at the same time. So I bring that up because I think it's important to note that just because the interest rates are high does not mean that it's a bad time to buy real estate. In fact, in 2019, it was one of the best times. And of course, somebody might argue, well, yeah, but the Fed lowered the interest rates, and so that really, amped up the returns. That's true. And I believe that the Fed will do the same thing with the current scenario. We don't know exactly when, and we don't know the pace of those reductions, but I believe that based on the economic data, the Fed will have to, without really damaging the economy, which they don't want to do. The goal here is to have a soft landing, not a hard landing. So I do believe that right now, in the current environment, is a very good time to be looking for value in the real estate space, and of course, particularly the multifamily space. All right, so I want to kind of switch from the first topic, which was looking at the data, looking at the overall Fed funds rate, looking at the GDP, things that go into the components of the economy, inflation, et cetera, and now switch to let's look at our industry, our particular multifamily industry. Where are we, regardless of the economy? What are the factors that are affecting our industry? And overall supply and demand, again, kind of going back to economics, overall supply and demand is really important. So first, I want to look at historical rental vacancy. And again, I took this from the St. Louis Fed, tracking the historical rental vacancy going back to 1950, I think it's before 1950. So we've got 70 years here, call it. Quite a bit of data. And as you can see, the rental vacancy is fairly consistent. It's not too crazy, except for back in 2008, 9, 10, when it went up to 10, 11%, which was an historical high number, had not been there since, I don't even know about before 1950. Very high number. And it was flashing to everybody, hey, we're not in a good situation. There's a massive oversupply, and there's probably a coming crash. Lo and behold, we got it. If you look at where we're at today, completely the opposite. We are at historical rental vacancy lows. 2022 right now, we are somewhere in the 5% range. In fact, I think some folks have said it's under 5%. So historically speaking, we are at a very low vacancy range for multifamily. Now, that range does not change overnight. Excuse me. In fact, you can see that it went from a historical high in 2010, and it took 10, 12 years to come all the way back down to a low point. That's a good amount of time, 12 years. During that 12 years, which I'm going to kind of further talk about, but during that 12 years, the production of new supply in the multifamily space was drastically less than what was needed. Now, when I say what was needed, I'm referring to new household formations that are looking for apartments, and we track those based on, people that are coming into the rental market, single people that are, folks that are moving out of their home, going to college, coming out of college, want an apartment, people that may be getting married that want an apartment, et cetera, that kind of thing. So we're tracking those people that are adding to the rental market. And the net effect is that we have a positive number of folks looking for apartments, and then we can track how many actual apartments are being built based on permits and completions. And so for the last 10, 12 years, it's been a shortage, which has led to this drop, very consistent drop in the rental vacancy for residential units. So again, I think it's really important to note this because we are at a completely different scenario than we were at back in 2008. When, again, we saw a lot of valuations fall apart. We saw debt percentages a lot higher. And so, again, a lot of factors that led to what we saw in 2008 that are not present in today's market. And so, again, my point here is that I do think there's some value. I do think there's opportunity, but I do not expect a wholesale discounting of the entire market like we saw back in 2008. Okay, so this is another interesting graph talking about homeowner vacancy. Now, again, single family homes and multifamily are different products, obviously. but they do affect each other. So if we have a whole bunch of single family homes that are vacant and the economy starts to crash, obviously those homes are going to be part of that rental stock that's going to compete with multifamily. So where are we at today? Well, as you can see, back in 2008, we had a very high vacancy, which contributed to what we saw 2009, 10, 11, 12. Today, we have almost a record low homeowner vacancy. Now, this is folks that own their home, but the house is vacant. So it could be a rental product if needed in a situation where the economy is really bad. So that vacancy is not there to absorb any shortage in the multifamily market. So again, you've got single family, multifamily across the board, low vacancy, not a lot of extra space here for people to go if they want to, if things get really tough in the economy, people say, you know what, I'm just going to rent. Well, there's not really much that can be rented. So again, that's a data point that's letting us know that even though we may see some value in our market over the next 3 to 6 months on a selective basis, we really don't have the same factors that we saw 15 years ago that led to this incredible opportunity to buy multifamily at almost a once in a lifetime discount. Now let's talk about the historical multifamily housing starts. So again, this is where we look at the number of units that are coming into the market, just pure numbers, not relative to anything else, but just pure numbers. The thing I want you to note here is that this goes back to 1950 again. So we've got about 70 years of data, 70 plus years of data. And on your left is the thousands of units that were brought into the market. So if you look at this graph, and again, this is not a logarithmic graph. And for some of you who know that basically means it doesn't take into consideration that the difference between 500 and 1,000 percentage-wise is the same as the difference between 100 and 200, which would show a different look. It's just a straight graph that's showing total number of units, multifamily housing starts. And if you think about it, back in 1950, maybe let's use 1960, we were bringing on roughly the same number of multifamily housing starts that we are bringing on today. Now, if you think about that, that's almost hard to believe that after 70 years of population growth in the United States, so we have, lots and lots of more people in the country, that we're still delivering roughly the same number of starts for multifamily. It's amazing. You would think, that this graph would just be a steady increase from the left to the right as the population of the country grows, but that's not the case. And of course, you can see through the, kind of the 1995 through 2008, it was fairly flat, took a huge hit after the Great Recession, came back, has been fairly level, and then just recently is starting to increase. So again, this is another data point to why there is this huge undersupply of multifamily housing in the economy right now. All right, so let's kind of transition from multifamily to what about kind of the comparison of single family and multifamily relative to the 30-year mortgage rate. Now, we all know the mortgage rate has spiked up quite a bit. You can see in the gray sort of background graph there, that's the 30-year average mortgage rate. It's up to basically where it was back in 2007, not quite as high as it was 2005 and 6, but it's back to that point. And as you can see also, typically speaking, as interest rates come down, the number of units and starts tends to go up. So lower cost of debt means that production goes up. Now, you can also see that multifamily basically leveled off from 2015 till about 2020, 21, and seems to be on a rise recently, whereas the single family market pretty much bottomed out in 2010 and has been on a very consistent upward trend until, of course, recently, when we know that housing starts have dropped tremendously because they're very sensitive to that 30-year average mortgage, more so sensitive than multifamily. But again, if you think about the overall housing starts for folks that want to live in a house of any type, whether it's rental or single, we're seeing that there's a huge drop in single family. There's somewhat of a pickup in multifamily to offset that a little bit, but it's nowhere near enough to create a situation where we're going to be in an oversupplied market anytime in the near future. And again, I think that's important because when you're looking at an undersupplied market, even in a challenging economic environment, you're going to have low vacancy, you're going to have increasing rental revenues and increasing NOI. So even if your cap rates are expanding, in other words, your values are dropping, your NOI, your profit is going to go up. And we'll talk about that a little bit later on how those two interplay, but it doesn't create a situation where properties are just worthless relative to what they were recently. They may go flat, they may level out, they may get a little bit of a discount, but you're not going to see this huge crash. Okay, so a little more data on this housing shortage, just to kind of wrap it up. So fewer new homes were built in the decade since the Great Recession than any decade since 1960. Basically, the bottom line is developers were not really willing to take risk of overbuilding and repeat of a 2008 scenario with a lot of debt and just a bad situation there. And then there's also been heavy regulation by the government, which has increased the cost of that development. So again, developers look at this risk-reward ratio and they say, hey, it's a lot of cost to develop this land. We got to hit a certain rent. And if we can't do it, then we're not going to. And so it typically only makes sense to do new development in major metro areas where you have high incomes, and those incomes can support that new development. All of that has led to this 4 to 5 million unit shortage. And bottom line, it will take a decade, probably longer than that, to recover from that shortage. So we are in a long-term, investor-friendly market or multifamily owner market where there is a severe shortage. And even if the economy takes a dip and we have fewer renters or folks that are less demand, we're still so far behind the curve that it's going to be tough to even come close to equilibrium anytime in the next decade. Okay, so that being said, let's look at effective annual rent growth and inflation. The reason I want to look at this is because if our investment can keep up with and or exceed inflation, that's the goal. We do not want to be behind inflation. If you look at the core CPI in the black mark, which is third from the top, it's got the orange, the purple, and the black. It's basically in the middle, sitting there at about 7% core CPI. You can also notice that the orange line for multifamily is massively outperforming the inflation rate to the tune of almost 3 to 1. That means that as inflation picks up, multifamily outperforms that inflation the best of any real estate class that you can get. So, I should say recently, because of course this only goes back to 2017. You can see sort of 21. Bottom line is, even though the interest rates are increasing, even though that means that cap rates are also increasing, which means values as a flat number would be declining, our rental rates are increasing at a phenomenal pace, which is more than making up for that potential decrease in valuation. I like to think of it this way. Let's just say we make $100 and that $100 is valued at a certain cap rate. Let's call it a 5 cap. If we're able to then increase that $100 and double it to $200, what cap rate increase would offset that increase in profit? Well, typically speaking, in multifamily, every 1 point increase in interest rates typically will lead to a 44 basis point increase in multifamily cap rates. So, and I know I might have lost a couple of you guys because we're getting a little bit technical here, but the bottom line is that multifamily outperforms any other asset class when you are in an inflationary environment where interest rates are increasing. So right now, when you think about parking your money on the sidelines where it's losing somewhere between 7, 10, 12% versus putting it into multifamily where you're actually getting ahead of inflation, it kind of begins to make you think, well, okay, I see the value in multifamily. I see the stability in multifamily. I see that it's long-term undersupplied and that the demand is going to be there. So maybe this isn't going to be a scenario where my investment is going to drop in value. Maybe it sits flat for a year and then it's going to come roaring back. So that's part of the case that I want to make here and why I think right now is a good opportunity to invest in multifamily. Okay, so let's kind of put it all together and look at absorption, completions, vacancy, and effective rent growth. Now, I think it's really important to look at absorption and completions because we don't want to be in a situation where we have so many completions, so many new units coming into the market that we cannot absorb those units. That would be a bad situation. That would be an imbalance in the supply and demand of apartments. And as you can see here, we've been in a fairly consistent completions and absorptions environment up until, let's see, we had a little bit of an imbalance in 2019, I believe, and then 2022, same thing, where we actually have more absorption than we have completions, meaning that the demand is outstripping supply coming into the market. And of course, that's leading to this low vacancy, and it's leading to a very high effective rent growth across the board. Now, I'm going to break down the rent growth a little bit more because I do think it's important to nuance the different classes of rent growth. And again, I think there's a place for every type of property. But it is interesting. If you look at this graph, you'll see a percent of units offering concessions. So we have A, B, and C. Typically, A-class units will offer a higher concession because typically when you're leasing up a new building, you're trying to incentivize people to come to your property. It's brand new. It is not an existing building. It's completely new number of units in that market. So there's typically higher concessions, which you can see. But regardless of that, and of course, like I said, B and C is a little bit lower because you don't really need to offer as many concessions. But the point here that I want to make is that if you look at the trend starting in June of 2020 and still continuing to today, the overall amount of concessions or the overall amount of incentives that we are having to give to our residents to get them in the door continues to drop. So we have an increasing rent growth. We have a decreasing amount of incentives that we need to give our residents to come in the door, and we have a decreasing vacancy. So again, all of these things are pointing to a very strong underlying industry strength when it comes to the actual business model of multifamily. And I guess, again, I'll kind of make this point as we get towards the end of the presentation here, but the bottom line is I do not believe that this is a multifamily industry challenge that we're in. This is a liquidity and a capital challenge environment right now. Those are the things that are driving what we've got. It's a capital and liquidity challenge that the Fed has created, and that is not going to last long. It is not an underlying economic problem. It is a Federal Reserve created problem and a government, to some degree, a government spending created problem. So again, I think it's important to know that because if everything was going in the wrong direction, we would have a different perspective. If the underlying economics of multifamily were no good and these trends were all going the wrong direction and the economy is weak, we would be in a completely different scenario than we are today. Okay, one other slide here that I think is interesting, and that is with regard to rent growth. So where have we seen the highest rent growth in our properties? If you look at this, you're going to see that A and B class rent growth has outstripped C class rent growth for the most part since about mid-21. Typically, C class properties outperform A and B. And of course, everybody's positive. There's no negatives here at all. It's all positive and it has been for about a year and a half. But your A and B class folks are really outperforming on a year-over-year revenue change by class. And again, I think that's because C class, generally speaking, is not going to have the same upside unless you are doing a value-add renovation. And of course, that's kind of our core competency, is finding opportunities where C class properties are undermanaged and under-rented, and we can create that revenue growth by doing renovations. But this is just looking at it and saying, let's just say you have a stabilized property, you put no money into it. What are you able to do with those rents simply based on the market being what it is today? And you can see everything is positive, and A and B class are especially positive. And if you think about this too, you think about 10 to 12% rent growth. That's huge. That's almost a 3 times the long-term average of what it typically has been, 3% for rent growth. So if you've got an A and B class property, 10 to 12% is where you've got to be today just to keep up with the market. That's a huge increase. And again, that's causing some heartburn in the property management industry, because it's hard to look at your residents and say, hey, I've got to give you a $200 rent bump just to keep up with the inflationary environment. But anyway, I wanted to bring this slide up because I think it's a really strong case for why good quality assets are going to continue to outperform in a rent growth scenario, and a sort of a working class C property. If you're going to be investing in a C class property, I think you want to specifically target value add C class properties where you can take that organic rent growth and add to it to get to that 10, 12, 15% rent growth similar to the A and B class. And of course, you might argue that a B class value add is the best of both worlds, because you're going to get organic growth plus the upside on the renovations. Okay, so I hope that made sense. Again, my goal with that section was to kind of look at the supply and demand situation for multifamily, which I think is pretty clear. There's a long-term shortage for supply in the multifamily business, which is leading to some really strong fundamentals right now in multifamily. Now let's look at the financing structure. Obviously, it's one thing to buy a property for cash and to have some great fundamentals, but what does that mean when we take that and we apply debt to our financing structure? And what is the right financing structure? So I want to go back here and take a look again, real quickly. The Fed funds, this is 2020, so this doesn't show the recent increase, which is obviously back up to the 3 to 4% level. But the reason I bring this up is because we've been in the 3 to 4, 5, 8% level before. The economy, the multifamily industry didn't disappear. We also didn't have, 50% discount in the market. We saw some opportunities and life went on. So this is not something that hasn't happened in the past, and it's not something that won't happen again in the future simply from a Fed funds rate. But what does that mean for a property that is leveraged and that debt, which obviously is costing more today than it did a year ago? What does that look like from an actual property net operating income based on an investor over a 5-year hold period? Now, again, this is assuming that rates stay high for 5 years. But what does that look like? Well, not surprisingly, as you can see from the graph here, the percentage of NOI or net operating income that is being spent on a particular property at a particular interest rate goes up quite a bit as the interest rate rises. So if you look at the left column there, we're assuming a mortgage rate of 3.5%, and we're spending about 46% of our NOI on debt service. As that goes up to 4.5% interest rate, we're spending 60%. And then as it goes up to 5.5%, we're spending 73% of that same net operating income on our debt service. So again, our profit margin has basically been cut in half by a 2-point increase in that mortgage rate. Now again, this is assuming that rental rates do not increase. So you're exactly the same rental revenue, you're exactly the same expenses, but what happens to your NOI? And not surprisingly, it takes a huge chunk, that debt service cost takes a huge chunk out of your profitability. So let's think about this in terms of overall opportunity in the market. Let's say that somebody has too much debt, their cost of debt is going up, and they're going to have to refinance that property. Does that mean that we could see some opportunities? I think we could. In fact, I think we're already seeing some opportunities. A perfect example is the property that we are closing on in a couple of weeks in San Antonio, where debt was maturing. Private equity group said, hey, we need to cash out. And there was some incentive and pressure on the seller to liquidate the asset, which then gave us the ability to negotiate a pretty good price, get our interest rate even lower, and we're in a great situation and a really good basis. So let's look at what the maturity date for debt is looking like today. Now, this graph has a lot of data on it. It kind of shows the different maturities of different maturities for different types of debt, or not types of debt, but maturities on debt. And overall, you can see that beginning in 22, 23, 24, we're going to have record high maturities in debt coming due, meaning this is debt that's outstanding that's going to need to be refinanced. And I want you to notice that the 0 to 3 portion is also at a record high. So over the next 3 years, there's going to be a lot of short-term debt that has to be refinanced. And if that refinance value is lower than what initially was planned, then the owner and or sponsor will have to come up with some additional equity in order to do that refinance. If they do not have the equity, or they can't get the equity, or they can't bring in a new partner to balance things out, then there would be a motivated seller, a distressed sale situation that we'll see in the market. Now, before we get too excited about these opportunities, I made the note about somebody being able to find the debt find the equity, because I do think there will probably be a large portion of properties that could otherwise have been a distressed sale that will be bailed out by somebody coming in and providing additional equity, getting a piece of the deal, and things roll on without too much drama. However, there will be, I think, some operators that do not have access to additional capital or don't have the proper working capital reserves, and they will be in a distressed situation. Again, I don't think this is going to be 2008, but they could be in a situation where you could see a 10, 20, 30, maybe a 40% decrease in the purchase price of that property, which would create an opportunity. So my point of saying that is that I do think there could be some select opportunities in the market for operators that know what they're doing and have proper liquidity ready to go to see some discounts. In fact, we're already seeing some of those with the properties that we're buying, where we're able to negotiate a 15 to 25% reduction in the purchase price, simply because of the increase in the interest rates and the cost of debt going up. Okay, so let's transition a little bit here and talk about the 10-year Treasury versus cap rates. And I kind of alluded to this before, but I think this is really important. So as the 10-year Treasury has slowly gone down since 1980, cap rates have basically trended with it. Now, obviously, you see the spread between those two since, let's call it the early 90s, has been positive, meaning that the cap rates have been above the 10-year Treasury. There have been times when that spread between the two has been a lot less, and times where it's been more. Generally speaking, when you purchase multifamily at a point where the spread is higher, you generally have a better cash flow position, at least initially. And generally, when the spread is less, you have a lower cash flow position, at least initially. Now, if you're doing value add renovations like we do, to some degree, it's not as relevant, because you're buying a property at a what I would call an artificially low cap rate, so it doesn't equate. But the bottom line is, at the end of the day, once you've stabilized that property, you want to have a positive spread between the cap rate and that 10-year Treasury or whatever borrowing instrument that you're borrowing against. Could be a 7-year Treasury, 10-year, whatever it is. So right now, as you know, the 10-year treasury has gone up quite a bit, and we're seeing a situation where those spreads are very narrow. So historically speaking, we have to go back to the late 80s to find a situation where those spreads were that narrow. And generally speaking, from a buying standpoint, that's not the best time to buy unless you have a unique opportunity for, let's say, a value add deal, or maybe you're able to find a really good deal because of a distressed sale. But my point in all of this is to note that in general, those cap rates will reflect the same trend that you see in the treasury rates over the long run. Now, let's think about whether it makes sense in today's environment. You've got a good property with a good opportunity. Does it make sense to lock in long-term debt right now? Well, the question you want to ask yourself is, do we think that the long-term interest rate in the market today is going to stay where it's at, going to go higher or lower in the next 3 to 5 years? Short-term debt is typically 3 to 5 years. So what do we think is going to happen in the next 3 to 5 years with that cost of debt? I believe, because of the factors that I pointed out in the beginning of the presentation, I believe that the cost of debt is going to come back down because the interest rates will also come back down because the economy will not be able to sustain a long period of higher interest rates. So I believe that the cost of debt is going to come down. And if you look at the 10-year treasury the 10-year treasury cost, which is the lower number versus the cap rates above, you'll notice that you see some swings in that 10-year treasury, but that cap rate graph really doesn't change a whole lot. So again, if you're seeing treasuries go up, your cap rates are not going to move much. If you see treasuries go down, your cap rates aren't going to move that much. So the opportunity here is that right now we're seeing 10-year treasuries fairly high. So I don't think this is a great time to lock in long-term debt, because I do think that spread is going to widen back out, and that's when we're going to want to go back and lock in some long-term debt. So if we buy a property today, we're buying opportunity, we're buying value add, and the goal is in 2 to 3 years, 4 years, whatever it takes, we complete the value add opportunity, we increase the NOI, we ride the rental increases that are coming or are already in place, and then we lock in that lower debt. So we're going to see a pretty significant pop in our cash flow when we do that, because our debt cost is going to go down even more than it would normally go down, because we've got a decreasing treasury rate at that point. Okay, so we talked about interest rates, we talked about financing structure, the cost of debt. Does it make sense to borrow in today's market? Does it make sense to borrow long term? What's the give and take? Now, before I get into the next section, which is talking about real estate being local, I also want to make one other point about financing structure. In our current market right now, the assets that we're buying are anywhere from $3 to $6 million less than what they would have been a year ago. So we're seeing call it a 10 to 20, maybe 25%, probably 10 to 20% price reduction versus what we saw a year ago. Now, that price reduction is coming at a cost because our cost of debt is higher because interest rates are higher. So what I like to do is think about what is my ROI? So if I'm getting something at, let's say, $4 million less, overall cost, but I have to then turn around and pay more for my interest on that investment, doesn't make sense. It's the same exact calculation that we do when we do a renovation. Does it make sense to spend $10,000 on a unit if we're only going to get a $100 rent bump? No, it doesn't. We want to see a higher ROI on our money. So the same thing is true with interest. So right now, if we're getting, let's just say, a $4 million discount in the price of our asset, and we're going to spend another $400,000 in interest over the next 3 years versus what we would have spent, does it make sense? Well, I think the math is pretty simple. If I'm going to spend $400,000 to get $4 million, over 3 years, that's a 10x return over 3 years. Let's just say, okay, you know what? Worst case, I spend $400,000 to get a $4 million profit over 5 years. Would you do a 10x return investment over 5 years? I think all of us would agree that's an absolute no-brainer. So again, I think the point here is that the way you look at financing and structuring the deal is important, because if you just look at the cost of that interest today and you say, wow, I'm spending $400,000 more, that is true. But what's the value that you're getting for that investment? Now, if you're not getting any value and you're saying you're paying the same price you were paying a year ago, it doesn't make any sense. But if you're getting a $4 million upside by spending that extra $400,000, I think it makes a lot of sense. Okay, so let's switch into the real estate is local concept, which is, of course, true in real estate no matter where you are. One of the things I like to look at is housing shortages around the country. And basically what we look at here is the geographic markets that are seeing the most housing shortage, the markets that are most affected by this dynamic in the industry. And as you can see here, the blue is the sufficient supply, so we have a fair amount of blue. And then the red is the very undersupplied, and the orange is kind of a, there's definitely a need for more supply. Now, you'll notice that there's a lot of red in Chicago, Detroit, all throughout the Midwest, the Northeast, California. To some degree, we get that because we have we have rent controls, we have high cost of construction. So even though people aren't necessarily moving there, there's just very little new product coming into the market. So there's a housing shortage and prices are going up. So again, if you invest in New York City, you're going to make a lot of money. Now, we don't invest in New York City. We invest in the Southeast, Midwest, and Texas. But that doesn't mean you can't make money in New York City. You can make money in Chicago. We don't invest in Chicago. There's a housing shortage there. You'll also notice, though, that you see Atlanta, pretty big housing shortage. Dallas, pretty big housing shortage. Birmingham, Cincinnati. These are markets that we're invested in. San Antonio, Houston, Tampa, Nashville, Charlotte, all of these markets where you've got housing shortages. So again, I think it's important to understand that because there are places that are going to be more or less affected by this housing shortage. And typically you want to be in an area that's more in a shortage than an excess. Now, I think it's also important to remember that there's different reasons for why you'd invest in an area. Like I said, the Northeast is a housing shortage, but there's different reasons for that housing shortage versus in the Southeast where you've got massive population growth, which ties into this next slide, which really shows you where that population growth is. And again, you see Georgia, Florida, Texas, Ohio. Those are places that we like to invest in. Really the only places that are at the low end, Alaska, the North, South Dakota, Montana, Idaho. I don't know who would live in Idaho. Just kidding, John. But there's, again, population growth is really important to understand because you want to kind of show all these data points as much as possible to make the most of your investment. Okay, so I didn't have a whole lot on that other than just say, hey, real estate is local, so it's very important, even in the midst of the current environment, to understand your local market, understand where there may be opportunity, where there may not. If the economy in your area is really weak or it doesn't have a lot of drivers for growth, then yes, the overall industry averages won't apply as much. If you're in a really strong area like Atlanta, Dallas, San Antonio, Tampa, Orlando, etc., tons of population growth, and you're in a supply and balance situation and the industry is in a really strong position, you're going to be outperforming even in the midst of a recession. And that's where we want to be as investors. So let's talk about inflation. I'm going to kind of state some obvious things here. Higher interest rates, what can that lead to? Increased cap rates, higher borrowing costs, lower income for the property, tighter lending standards. We're seeing that across the board. It's kind of the duh. What does that correlation typically look like? Cap rates versus interest rates. Now, this is a pretty complicated data graph, whatever. There's a lot of data on here. Here's what I want you to take away from this graph. The overall
correlation between cap rates and interest rates is relatively close. However, multifamily typically is the least correlated in terms of cap rates to interest rates. So other real estate investment classes are more correlated. Multifamily is the least correlated, meaning if interest rates go up a point, cap rates or valuations for multifamily are the least affected real estate asset class of any. And of course, that's a good thing. We want that to be the case, especially when we're in an increasing interest rate environment like we are today. Now, let's just take that knowledge, but then apply it to the leverage that we put on a property and think about why it's so important to be careful with our leverage and also have liquidity and working capital. If we take a property and we buy it at a 4 cap and the interest rate goes up 2 points and we bought it at a 65% loan to value, our leverage, our effective leverage has gone up to 98%. So we're not underwater, but it's gone up quite a bit. Not really a place you want to be, but a place that you could probably survive because you are not underwater. You're not over 100% leverage at that point. So you can cover your debt service. So if you look at 65% loan to value, which is pretty conservative, even at a 2% increase in cap rates, your various cap rates at origination, you're going to be fine. Even if you buy some at a 4 cap, you're going to be okay. And that's my point of doing this. Now let's see what happens as we increase the leverage of our property. So 75% leverage, cap rates go up 2 points. We're underwater, 113%. 4.5 cap, we're still underwater. 5 cap, we're still underwater. 5.5 cap, we're still underwater. 6 cap, we're barely breaking even. Now let's go to 85%. Well, as you can tell, if you buy a property 85% loan to value, it almost doesn't matter what cap rate you bought it at, you're going to be underwater when the cap rates start to increase. So bottom line, it really doesn't matter what is going on with the interest rate or the cap rates. If you over leverage your property, good luck. Don't do it. And that's why we're so picky about deleveraging our properties. And that's exactly what we did on the San Antonio asset is we actually lowered that to 59% because I felt like it was the right thing to do in this market to ensure, excuse me, to ensure that we could stress test a significant increase in the cap rates and still cash flow property. Okay. So I want to really stress that point about leverage and using financing in a proper way and making sure that you have liquidity in order to be successful in this business. Let's move on real quick and talk about why the cap rate spread is important to watch. Now, on this, I've got the cap rates of all property types, and then I've got apartments, which is kind of the purplish line. Bottom line is, in general, the cap rate spread for multifamily is generally the lowest spread, meaning multifamily is considered the lowest risk. Anytime you have a lower spread, it's lower risk. So multifamily is considered the lowest risk real estate class because it's so consistent, it's so predictable. The values don't really change much, given that you've properly structured the financing, given that you have a sponsor that knows what they're doing, given that you are, running a professional organization. But I think that's important to understand that multifamily is generally considered the lowest risk of the real estate classes. Now, this property value versus interest rates kind of goes back to what I was saying earlier about the change in the value of the property versus the increase in the interest rates. So as interest rates go up, cap rates go up, not one for one, but they do go up. And so what happens to the value of the property? Well, the value of the property then goes down, all other things being equal. Now, as I mentioned in the beginning of the presentation, we can increase our rents, which increases our profit, which can offset that potential decrease and probably actually more than offset it to where even in a recessionary environment, even with interest rates going up, we're actually still increasing the value of our property. And I know a lot of people think, wow, how in the world is that possible? But if you think about increasing your profit, if you increase profit from $100 to $200, even if the value, the multiple on that money goes down, if the multiple doesn't go down to the same degree as your increase, your value is still going up at the end of the day. And that's what we're seeing in our market right now. So I want to kind of wrap this up with a simple example. What's the solution here? If our property, if interest rates go up, cap rates go up, and values go down, what do we need to do to make up for this increase in the interest rates and the decrease in the property values? So right now, if you look at what's happened with interest rates and you compare it to what's happened with cap rates, given the historical average, we need to raise our rents $110 a month, $1,320 a year, assuming a 6% cap rate, and that will give us a $22,000 per door increase in value. That's what we need to do in order to simply break even with what's happened with interest rates. Is that possible? Absolutely. Are we doing that on almost every single one of our properties? Absolutely. So again, I think it's important to remember that. Have we been used to seeing property values just go through the roof constantly and it's like it never ends? Absolutely. Are we in more of a operator's market where we actually have to run a business for profit and increase our rents to keep up with inflation at this point? Absolutely. Can it be done? 100%. And so that's kind of the metric that we're using to say, hey, if we can exceed $110 a month, if we can do $200, if we do $300 a month, we're staying ahead of that decrease in value. And we're still creating value for ourselves and our investors. And that's the goal here. And it can absolutely be done even in a recessionary environment. So I think that's kind of a key takeaway here. Now let's think about one last thing, which is what I call the election effect. Now we had some changes in Congress, which I think are positive. And I don't mean that in a political sense. I'm just strictly talking about multifamily and how it affects what we're doing as investors. So there were some policies and spending programs that were potentially going to get pushed through Congress. That will probably stop. Maybe it'll go backwards a little bit. That's a good thing because government spending is in direct opposition to what the Fed is doing with regard to inflation. So if we can get government spending to slow and or at least just stop, that will help to bring this inflation rate down. Secondly, regulation also causes inflation. So I believe that because of the recent elections, we will probably see a moderating effect to those regulations, which will help also to lower inflation from a governmental standpoint, and regulation cost standpoint. And I think those are both positive. So again, I'm kind of pulling together different data points from the CPI, from the cost of food, from the cost of shipping to the election to make the case that I think we're going to see some moderating effect in the inflation environment, which combined with the weakness in the economy will allow the Fed to slow the interest rate increase and then eventually bring it back down, which is making this time right now, I think, a very opportune time to pick up some quality assets at a significant discount. Okay, so that is a wrap, guys. I apologize, that was a little long. So thank you for hanging in there with me. As you can tell, I feel like there's a lot of good data here. So I thought there'd be some great takeaways. We're going to obviously send this out to you guys so you can get a copy of it, review it if you want to. But that's kind of our thought process. That's where we're at. That's what we're looking at today. We really believe there's good opportunities here. And so that's kind of the thought. Again, thanks so much for joining us. Really appreciate it as always. It's great to connect and talk and share. Hope that was valuable for you. John just posted a calendar link up there. So if you have any questions and we can be a resource, please reach out. Love to chat. And, again, there's a lot of unknowns out there. And I understand the fear that's out there. And, not to say that I've got the crystal ball that can tell the future, but I do like to come back to the data. And I hope that I can be a resource for you guys so that you can make good decisions. And so that a year from now, we can all, be sharing our successes together. And hopefully we've made good investment decisions and move forward. So anyway, with that being said, happy Thanksgiving. Have a great evening And we will talk next time, guys. Thanks. Take care.